crowding effect of public investment on private investment in developing countries, and evidence from official external finance. So before I start, I'll give a very quick summary of the work, which is the primary reason why we are trying to even investigate these questions to start off with. So we answered two related questions, and these questions basically first tries to uncover the structural relationship between public and private investments in developing countries. And the rationale behind wanting to look at the structural relationship is partly because of the marginal productivity channel, which is one of the key channels to which public investment affects private investment. The whole idea here is that if public and private investment are what we call edgeworth complements, then every dollar increase in public investment would enhance the marginal productivity of private investment and hence increase private investment itself. But then there's also another part, which is the crowding out bit, because for every dollar that the government spends, it has to find a way to finance it. And the financing oftentimes can come through debt, taxes, or something else, right? So once the government is trying to finance it, let's say through debt, then it's going to compete for domestic resources within the economy, which would then sometimes limit private investment because it would crowd out private investment as government would take a lot or a chunk of the resources. So that's the first related question. The second related question is to quantify the impact, which we have heard several times in any macroeconomics class that we've taken, is the multiplier effect, right? So you want to see how $1 additional increase in public investment leads to X dollar increase in private investment, right? And why does it matter? It does matter because of the fact that once we're able to quantify the multiplier, it can give us a little bit of insight on how public investment can be used as a macro stabilizing tool. For instance, during recessions, government can actually use public investment to help spur the economy back up. Right, so these two questions are what we look at, and as I will show in a few slides to come, the two questions are related. So how do we answer these questions? First, we use very simple theory just to kind of motivate the structural relationship. So we start off with the neoclassical production function to help us with the structural interpretation. And what we kind of focus on is the edgeworth complementarity channel and the crowding channel. The model kind of helps us nicely identify the edgeworth complementarity channel. And because of the identification strategy that we use, we can also draw inferences on the size of the fiscal multiplier, hence the crowding in or crowding out effect that we try to look at. And we use a large panel of 109 emerging markets and developing countries from the period 1980 to 2019. As you can tell, we preclude the 2020 period because of the COVID crisis, which extended for a little while. But more importantly, the start-off date was also limited by the GDP data source that we use, which is the World Economic Outlook, which starts its data from 1980. So when it comes down to the empirical strategy that we use an instrumental variable estimator to uncover the structural parameter and the crowding in effect, which we identified through the IV estimation. And the instrumental variable that we use is the predicted disbursement on loans from official creditors to emerging markets and developing countries. And this instrument is a recycled instrument because it's been previously used by some co-authors, some authors within the World Bank, Art Cray and Maya Edian and co. So we take this IV, we update the IV because they did it up to 2010, we update it to 2019, and we try to use it for our identification strategy to uncover the key parameters of the model. Sorry. So what are the key findings? Key findings are that, one, public investment is an edgeworth complement to private investment, which means that an increase in public investment tends to raise the marginal productivity of private investment and hence can also lead to the increase in the level of private investment itself. quantitatively, we do find that an additional dollar increase in public investment financed by increase in external finance raises private investment by $1.8, right? So it raises it more than $1. And a very quick and simple implication of our result, and as I will show, is that as part of our sample, low-income countries are in there. You have sub-Saharan African countries where I come from Ghana, countries that oftentimes struggle a little bit to get access to international capital markets, or capital overall happens to be a little bit scarce. So our result pushes and makes a strong case for external financing, particularly in low-income countries or countries where financial markets are not terribly developed, or the access to finance is fairly costly in those countries. So just a second, why look at investment overall before going into the weeds and looking at the results and everything? A little bit background would help. And we focus on the sample endpoint for us, which is 2019, partly because there isn't the data source that we use is not extended just yet. It ends at 2019. But there is an issue of the missed opportunity when it comes to investment. And the rationale is a very simple one. In the pre-2020 period, before we entered into this high interest rate environment, we used to have the low interest rate environment due to the persistent zero lower bound that was in place for a very long time in a lot of developed countries. And this made interest rates fairly low, and hence, quote unquote, assessing capital at a lower cost, right? But as you can tell from this graph here, panel A, we see that post 2010 up until 2019, there's been a steady decline in the share of public investment in GDP in both emerging economies and low-income countries, right? And you would think that though interest rates are very low, a lot of countries would take the opportunity to borrow a little bit more because it's cheap and to conduct more investment. But I'll also mention a little bit why this was the case, why we saw a decline in the public investment as a share of GDP. Another telling point here in this graph is that the overall level, or the average level of public investment as a share of GDP in low-income countries compared to emerging economies is fairly low, right? It's lower. So there's two issues here. One, the level of public investment as a share of GDP is already low in developed low-income countries. In addition, it's also falling, right? So there's already a need for these countries that oftentimes have challenges with infrastructure and overall investments within those countries to see an increase to help their countries grow and try and also crowd in private investment. On the private investment side, for emerging economies, we see almost a flat line. We hardly see an increase or even a major decrease. It's almost very flat. Whereas for low-income countries, we see a little bit of a steady rise, but it is also, in terms of the level compared to emerging economies, it's low on average, right? So there is a genuine problem that, one, investment rates pre-2020 have been falling. Post-2020, a lot of countries are trying, the COVID pandemic did show a lot of infrastructure gaps in health, education, amongst other things, right? So a lot of countries post-COVID are restructuring first their debt and all that, but they're also paying attention into expanding investment and infrastructure within their countries. But these countries, now we live in a relatively higher interest rate environment, and this has made overall capital a little bit more expensive, right? So there's a real investment challenge in a lot of countries, and globally there is, and the World Bank has estimated a huge gap for increase in investment in order to achieve some of the sustainable development goals, amongst other goals that are in place in these countries, right? So why is it that we didn't see a market increase in investment, even though interest rates were fairly low pre-2020? And there are several reasons, right? Even before 2020, several countries were struggling with limited fiscal space and capital market distortions or inaccessibility to the international capital market, right? So for some countries, particularly some countries in Sub-Saharan Africa and some low-income countries, had high levels of debt and as well as constrained revenue bases. In that even though they may have a huge base, they haven't accessed the whole base. So revenue collection was fairly a challenge in order to help finance some of its investment needs. And more importantly, is a lot of countries or some countries also face limited access to international markets. And some also had poorly designed tax systems, so they couldn't really raise a lot of domestic revenue in order to finance investment. And an example is Zimbabwe, that for a very long time did not have access to the international capital market until recently, I think in 2024, and now I think in January 2025, they are putting in structures in place, including restructuring debt, amongst other things, in order to be able to get access back to the international capital market. Now, I don't know whether they are back fully, but I do know that there's work being done in order to help them be able to access international capital market. But that's an example. So even if we were in a low interest rate environment and the country wanted to even invest more in all that, coupled with its high debt, constrained revenues, other bureaucratic issues, including weak governance, amongst other things, sometimes can slow down the increase in public investment. And of course, a standard story that we always know is weak institutional capacity, right? Inefficiencies in governance hinder the efficient implementation of public investment projects. And we know that things like government effectiveness, corruption, bureaucratic rules, bureaucratic measures, or weak regulatory measures sometimes create a barrier, reducing the impact of public spending. So there's a case where government can actually spend or invest more, but because of all these weak governance or institutional issues, it may not necessarily translate one for one into crowding in, let's say, private investment, or even translate investment into new capital. And of course, political instability has been a problem. Frequent changes in leadership or political instability overall often result in shifting priorities, right? Which often stalls long-term projects and also deters new private investment coming in. And you also have one of the most interesting ones is the issue of maintenance, where in a lot of developing countries, or particularly low-income countries, aging infrastructure and limited resources for maintenance make it difficult to sustain public investment. And what is very interesting here is that sometimes going ahead to the cost associated to repairing and maintaining existing infrastructure in a lot of low-income countries or developing countries in general, sometimes the cost is way higher than the benefits of new investments, right? So this leads to a cycle of degradations and missed opportunities, okay? So a quick literature review. The work on public-private investment relationship, or the crowding effect, is not a new topic. It's been around. People have investigated it for years past, and recently a few papers have also looked into it. A few differences, however, is that most of the existing literature has either focused on a very limited number of low-income countries like Eden and Cray did. They focused on just about, I think, 39 low-income countries. And they do find out for every additional dollar of public investment, private investment increases by $2, right? So very similar to our work, but our work expands the sample from just the 39 low-income countries to 109 emerging markets and developing countries, which includes their subsample. A recent study by Bohm focuses on OECD countries, the more developed countries, and finds that public investment crowds out private investment. The key reason for his finding in this context is that the intertemporal elasticity of substitution demand for investment is very, very high in developed countries. And with high intertemporal elasticity of substitution, what you have is that the negative wealth effect on labor supply, which oftentimes comes because the government has to finance, let's say, the increase in investment or spending by or through taxes, happens, the intertemporal elasticity of substitution happens to be very high. So that negative wealth channel that oftentimes comes in through the financing of investment with taxes tends to be very, very small, right? So what you see is that labor supply, which often would go up so large, is not the case in developed countries. So he finds the opposite effect in the context of developed countries. He finds out that public investment actually crowds out private investment, and the key channel is because of the intertemporal elasticity of substitution of demand for investment. And then Esquerdo and co. do find that for European countries and United States and Argentinian provinces, they do find strong evidence of crowding of private investment. So one of the key things that you see immediately with the listed literature is that our work and the sample that we use differs very much from the sample used here. Most of the sample has either focused on developed countries or specific provinces like the Argentinian state. And the Eden and Cray paper that is mostly closest to our work focuses on just 39 countries, right? So there has also been a lot of earlier work that has followed you want to call it maybe a seminal paper by Ashwa, 1989. A lot of them have done the crowding in, crowding out effect of public investment. But a key limitation of this work is that it tends to kind of focus a little bit more on correlation rather than causation because of plausible issues with endogeneity in there. Okay. So I'll skip this part because it's part of the literature review, but I just want to briefly touch on a key point here, that the fact that public investment crowds in private investment does not necessarily always mean that it is desirable to keep increasing public investment, right? Because we all know the law of diminishing marginal returns, right? There's a sweet spot where after that, additional investment may actually have a detrimental impact on the economy as a whole. So just by quantifying the crowding in effect of public investment on private investment is not a sufficient indicator. To know whether you need more capital or more investment, you have to look at the returns of public capital. Okay. So in the presence of diminishing returns to aggregate capital, crowding in tells us nothing about whether the level of public capital is too high or too low. Okay. And some papers, and the paper that came before us, the Eden and Cray paper, does find that under strong complementarity between public and private capital, which means that public investment crowds in private investment. In their case, they were able to compute excess returns between 5 to 170%, meaning that there's still room. The returns on government investment is very high, and hence there's room for more investment in these countries. Okay. So what is our contribution to the literature? The first bit is very pedestrian. The pedestrian bit is that The story about crowding in or crowding out is well known. Everybody knows it. But one of the things that we try to bring on board is a systematic evidence based on a large sample of countries, which is 109 economies. And we look at it over an extended period of time. So we use both historical and more recent data. And the work also points to the important role of external finance, partly because of the factors that I had mentioned earlier, right? For a lot of developing countries, borrowing to finance public investment can be very expensive. But external finance from institutions like the IMF, the World Bank, and a bunch of other institutions, bilateral borrowing can sometimes help with the financing aspect, because some of these finance that come in have a decent amount of grant element in there or concessional bit in there, which sometimes reduces the burden on government to pay back the money it has borrowed at a high interest rate, right? And the other bit, which is very important, is that the work opens the door wide open for future research. And the reason is very simple. The instrumental variable that we use, which I'll talk about in a second, focuses largely on external finance with grant elements and all that. We therefore preclude from the analysis the episodes or periods where government investment is financed by domestic resources or things like taxation, domestic taxation, right? So our work is focusing on one aspect where you have external financing coming in, which has grant elements and hence may relax the financing constraints that countries face and hence may enhance public investment and its impact on private investment. But there's another bit where we need to know whether if government actually finances investment with its own resources, which is taxation, how will the results change or look, right? So we don't look at this in our work, and hence it opens the door for anyone who wants to look at just the general impact, including both the external financing and domestic financing, to see the impact of public investment on private investment. So what is the impact of public investment on private investment? Like I said in the beginning, it's a tussle between two effects. One is the crowding in effect, and one is the crowding out effect, right? The other is the crowding out effect. And the net effect is the total impact of public investment on private investment. The crowding effect comes from the marginal productivity channel, where an increase in public investment goes on to improve or enhance the marginal productivity of private investment, and hence will, all else being equal, raise the level of private investment. On the other hand, there is the financing aspect. So if we shut off the fact that government is borrowing at a lower interest rate from abroad or getting external finance, but instead it's focusing on financing its increase in public investment with domestic resources, then you're going to have a competition of domestic resources, which would oftentimes, government is huge. So sometimes competing for these resources means there are limited resources for private investment, and hence this will push out private investment because interest rates will go up, and as interest rates go up, the cost of capital goes up, and this will make private investment a little less attractive, right? So there are two moving forces, which is the marginal productivity channel and the financing channel, which leads to increase in interest rates, and the net effect would be a positive one, zero, or negative, depending on which effect is the dominant one in the story. However, there is a very interesting point in that if the financing happens to be coming from external sources, which has maybe a huge grant element, or it does have concessional loans in them, this will relax the budget or the financing bit of countries, and hence the competition of resources wouldn't be as fierce as in the case the government is trying to finance its investment with domestic resources. Okay. So this tussle, like I explained, comes in this nice setup here, in that when you have edge complementarity between public and private investment, an increase in private investment raises the marginal product of private capital. But what is the idea of edge complementarity, right? So take, for instance, the construction of an improved highway system or a port system in a country that maybe has weak ports or didn't have very good roads, and now all of a sudden there's a good several good highway system in the country, and also a good port system that can help with the easy trading of goods and services abroad and even within the country sometimes. What you would see is that this increased the productivity of the private industry overall, because all of a sudden, let's say the amount of time it will take a private entity to move one good from one point to the other, one region to the other, is much faster now because there's a good highway system. Or the time it will take for it to be able to go take out machines or imports from the port system is much faster now because it has a good port system. This would, unambiguously raise the productivity of the private industry, and hence private investment, right? You can also think of irrigation projects in, let's say, rural areas and all that. And you consider some rural areas that don't have, let's say, irrigation systems and are very dependent on rainfall, amongst other things. That is putting your crops at chance, right? So even private investors wouldn't want to go into such a business because they are not very sure whether they will be successful or not. However, a good irrigation system or irrigation project can help crowd in private investors, right? Because they know that there's a good system, there's some level of sustainability to help improve their agricultural produce. And this can also bring in other type of businesses like transportation businesses, because there's booming agriculture, amongst other things. There can be a connection between the rural and urban area, and that will bring in more businesses, let's say in the transportation industry or the services industry, for instance, right? So these are some of the channels through which the marginal productivity channel happens. And then you have the other part, which you have the crowding out that I explained, that competition for available resources by the government to finance public investment tends to increase interest rates. And as we know, higher interest rates means the cost of capital is generally expensive, and this leads to the crowding out of private investment, right? So the negative interest rate channel can then reduce crowding in effect from the complementarity channel, right? And the net effect is what we try to quantify. But like I mentioned, external financing tends to reinforce the crowding effect if it has this grant element in it. Okay. So isolating the effects of public investment and private investment then remains an empirical question, which we try to focus on in our work. Okay. So this is the simple model that we use. I'm going to skip the model and just go to the empirical work that is behind the results. And the key parameter that we are looking at is this alpha here, which captures the complementarity between public and private investment, but also captures the crowding in effect that I'll explain in a second. So a positive value of it means that there's crowding in, and hence an increase in public investment crowds in private investment. And it also speaks about the complementarity between public and private investment. If alpha is negative, then you have substitutability or crowding out effect in that context. And if it is zero or statistically non-significant from zero, then you have that public and private investments are independent in the production function, such that an increase in public investment does not alter the marginal productivity of private investment, in which case the crowding out effect might be dominant, right? So we face a lot of econometric challenges, the standard ones related to endogeneity, amongst other things. And endogeneity can arise because of so many factors, including global shocks, omitted variable bias, or the cyclicality of public investment itself. And another, and perhaps one of the more important issue, is the measurement errors in investment. The investment data that we use is also computed based on a model and from the IMF, and there are challenges with that where sometimes we've seen measurement errors amongst other things, right? So in the presence of these econometric challenges, you are likely to estimate a biased coefficient or face the challenges of endogeneity, which would then impact the accuracy of your estimate. To help address this, we use the instrumental variable strategy to help identify the investment shock. So our empirical strategy focuses on two SLS, the two-stage least squares model for this equation here. Okay, so our instrumental variable is based on, as I mentioned earlier, average disbursement is based on predicted disbursement from international organization or official entities across the world. And this includes both multilateral and bilateral creditors, right? So we construct this instrument following Eden and Cray and Cray 2014. And the rationale behind this is that official loans finance a significant portion of government spending, particularly the investment component, right? But disbursement of these loans and the spending they finance are spread over time, many years following the approval. So if you think of a country like my country, Ghana today, receiving a certain amount of loan coming in today, that loan the decision wasn't based off current economic issues. The loan was approved years ago and is just being disbursed over time, right? So what you want a good instrument to be is that you don't want it to be correlated to the current economic shocks that we face. And so the loan approvals, because they happen way in the past, are predetermined, and then they are disbursed over time, right? So the computation of the predicted disbursement by construction shouldn't and do not respond to contemporaneous shocks because they were decided long ago and they are just being disbursed, right? So we clean the data, we do a lot of work. We start off with 122 emerging countries. We do a lot of censoring work. My co-authors and I work and clean the data, amongst other things. And then we end up with 109 countries over the period 1980 to 2019. And then we use the World Economic Outlook data, which starts from 1980. So the starting point is because of the data we use for GDP, and the end point is because the investment data stops at 2019. And it's also just beneficial that we don't look at the 2020 period because of the huge shocks. So this is the average disbursement. So when a decision is made at time T and a loan is approved, the first year of the loan approval, about 14% of the loan is actually disbursed. And then over time, it slowly is disbursed and it declines, right? So you see that in the first, I think the first 2-3 years, that's where you see the most amount of the loan disbursed together. And then over time, you just slowly see smaller disbursements over time until the full loan is fully disbursed. So like any IV, I'm just giving a point here that our IV is not perfect. It's not a silver bullet. It has its challenges, and Lisa, I can talk about it if there are any questions related to that. But to jump straight to the estimation results, these are the key estimation results. And what we are looking at is panel B, right? And at the top here, the baseline or H0 is what we call the contemporaneous or the impact multiplier at time T0. So in year, when government increases its spending by X dollars in that same year, or the contemporaneously would expect an increase in private investment. So the baseline and H1 are just the same model. One just controls for the lag of GDP and the other does not. So the baseline results does not control for the lag, and H0 does control for the lag. And we'll focus on H0 or even the baseline. But what you see here is that a dollar increase in public investment, which is the change in public investment, additional increase in public investment financed by external loans, increases private investment by $1.8, right? And if you control for the lag effect, which is horizon zero, it's almost the same where you have $1.6. And over time, over the horizon, year one, year two, after the shock, the effect that we see is that the impact of public investment on private investment increases. But by year four, we see that there is a statistically non-significant impact, so it kind of dies out by then. And one of the key things that we want to see is what's the relationship between our predicted disbursement of official loans, which is our IV, and its impact on the change in public investment. So you can tell that at the first stage, the IV that we use is strongly correlated with the change in public investment, okay? And in IVs, you always want to look at your F-stats, and our F-stats is a little bit on the margin because it's slightly, in some cases, above the rule of thumb of 10, but in some cases, it's slightly below, right? So we do also report the weak IV consistent confidence interval to make sure that our estimated coefficient does not include zero, and you can consistently tell that the confidence interval consistently excludes zero in it. So our results are fairly statistically significant, and we can rely on them and say that public investment actually crowds in private investment, right? And naturally, it's important for us to also look at low-income countries and sub-Saharan African countries, partly because they are very, very important regions in the sense that they have low development levels, but at the same time, they are trying, or they're in the trajectory of trying to get to middle income levels, right? So when you look at the estimated coefficients, you consistently see a positive and statistically significant estimated coefficient, often strongly greater than 1, right? So for every additional dollar that is spent on public investment, we see private investment increase by $1.5 in the case of low-income countries. For either countries, the statistical significance is slightly on the weaker side at the 10% level, but if we are remaining agnostic about that, you can also say that a dollar increase in public investment raises private investment by $2 in either countries. These two results are fairly similar to the Eden and Cray results in the context that the size of the multipliers are fairly similar. And for sub-Saharan African countries, you also see a similar trend there. And what's more important is that the longer term multipliers are also still positive and statistically significant, right? And you recall that when we started the presentation, we talked a little bit about the corruption bit or the weak institutional capacity, which oftentimes stifles public investment from being very productive. And in that context, you can tell that countries that have higher corruption control tends to have multipliers that are positive and statistically significant, and over time they also are greater than 2, right? Whereas for countries with lower corruption control, we do not find any statistical significant estimate of the crowding effect or the complementarity. And there are both technical and intuitive reasons for this result here, but we stick with the intuitive part because we can clearly tell that countries that have higher corruption control, you are likely to have more efficiency in public investment and hence higher increase in the effect of public investment on private investment. Yeah. So these are a bunch of other things that if you're interested, I can talk about, but it's just robustness to show that whatever we've done is the results are fairly stable and consistent and they're robust, but they are telling the same story. I'll briefly go into this and then I'll conclude that, again, we made the point earlier that for a lot of developing countries, they face capital market distortions or the imperfect capital markets. And we also quickly ask the question that does the fact that public investment crowding private investment suggest that we should keep increasing public investment perpetually? And the answer is no, because you have the law of diminishing marginal returns, right? But for a lot of developing countries where capital market imperfections or distortions exist, some papers have shown, which is the equation 7 here, have shown that in the presence of capital market distortions, right, public investment should be allowed a lower marginal rate of returns compared to when capital markets are perfect. And I'll explain this very briefly. When capital markets are perfect, you should expect that the returns of public investment and private investment should be equal, right? Based on this equation right here. But in the presence of capital market distortions, that discourages private investment. If public investment crowds in private investment, the latter, which is public investment, should be allowed a lower rate of return compared to the scenario where capital market distortions exist, right? So in this context, we cannot just go ahead and interpret public investment returns like we do in a standard framework where there are no capital market distortions, because in the real world, there are capital market distortions or imperfect capital markets. So in conclusion, the results that we've shown so far has clearly shown that there is a strong positive relationship between public and private investment, and that the two are a direct complement, so that increases in public investment raises or enhances the marginal productivity of private investment. And quantitatively, an additional dollar of public investment that is financed by official external funding raises private investment by $1.8. So in our study, the extra dollar is funded by official external finance, and results are also reinforced in the case of low-income and sub-Saharan African countries. And one of the key conclusions from the work and the paper is that governance matters, in the sense that we show that countries that have stronger corruption control, which often is also correlated with other things like strong regulatory quality, political stability, amongst other governance factors, does show that countries that have stronger governance tend to see a stronger crowding in effect in that context. And the key implications here is that public investment can be an effective policy to address private sector underinvestment, which we've seen in several developing countries. And the result also makes a strong case for more official finance for public investment, particularly in low-income countries and sub-Saharan African countries that tend to have limited access to affordable finance, or in some cases, no access at all to international markets. And of course, the next steps is to try to extend the work and bring in a little bit more broader financing strategies, which includes the domestic financing through taxation, amongst other things. Thank you. And I think I learned one Korean word today, which is gomasmida.